Hey, wholesaling subject to deals in 2026 is dying, in my opinion, because I've been hearing from wholesalers who are being sued either by a seller, the buyer, or in some cases, both. They locked up a subject to deal, couldn't find an assignee with enough cash to take over the property that left the seller facing a foreclosure auction with no way out, lawsuit. You see, in 2026, a failed assignment is not just a lost fee for you. It's a possible legal liability that can take your personal assets if you're doing it the wrong way, if it's not structured right. Here's what you're going to learn in this video. I'm going to teach you how to structure a subject to wholesale transaction the right way to make sure you're protecting that deal from the due on sale clause with banks. I'm going to talk to you about how to structure your deals if you're a wholesaler so you minimize taxes and protect yourself from lawsuits. And then we're going to talk about the necessary documents that I feel every wholesaler who is putting together one of these types of deals needs to have in their back pocket to make sure they're protecting themselves on that transaction. All right. Let's get started. Okay, in a standard wholesale deal, the way it typically works is that the wholesaler, you, if you're watching this video or you're thinking about getting involved in it, you're going to go out and you're going to find a property that you know has enough meat on the bone, meaning you can flip it to an investor who will step into your shoes and close on that deal. So typically what we're doing as wholesalers is that we're tying up the property for a set price and then we're selling it to someone else for an assignment fee who will then close on that deal. Now, the wrinkle for wholesalers now, and I've seen more and more of this, is that wholesalers are not looking to just tie up the property and have it move directly to the buyer. They're looking to do it via a subject to transaction, where we're actually moving the property to the buyer subject to the existing mortgage on the property. Now, this creates a whole other set of potential issues that you need to be aware of if you want to wholesale property. And the first one typically starts with how you're setting up the transaction, because that is going to be critical to make sure you can document this deal properly from A to Z and make sure it works out in the buyer's favor and of course the seller so they know they can close. Okay, so when you're wholesaling subject to property, it's completely different than the standard wholesale deal. And what am I getting at here? Let me just show you. So in a typical wholesale transaction, what will oftentimes occur is we have a property over here. Okay, here's the seller. They have this property, and the wholesaler will typically have an entity. And I'll talk a little bit about this more later when I teach you what is the proper entity if you're engaging in these types of transactions to minimize your taxes and provide you asset protection. But anyways, it typically will start out like this. So I've got my LLC here, and what I'm going to do is I'm going to approach this seller and I'm going to enter into a real estate purchase and sale agreement. And typically with that real estate purchase and sale agreement, it's going to be in the name of my entity with additional language in there such as and or designated entity. So if this one was Red LLC, it would say Red LLC and or designated entity. Okay, so why is this important to have this additional language here that you probably can't read? I know I'm going to get some comments on it. The reason we want this language in that agreement is so that this and or designated entity clause allows us to transfer this contract that I hold to buy this property to a third party over here, right? My end investor. So the wholesaler, you're standing right in the middle there. So that's generally how we set it up as a wholesaler. Now that and or designated entity language, I'm just going to take a sidebar here and I want to explain something to you. Why do you want to use that language and not and or assigns? The reason we don't use and or assigns, or I prefer for our clients not to use that language, is because it's been overused and it's a dog whistle to anyone who's looking at it to know, hey, I'm dealing with a wholesaler here. When you use and or designated entity, what I have found personally, as well as working with these transactions with wholesalers all over the country for the past 10 years, the and or designated language, if someone picks up on it, you have a very easy explanation. And that explanation should always be as follows. I put that language in there because my CPA or attorney, you fill in the blank, is concerned about how the title to this property might ultimately be held for estate planning or tax planning reasons. And so I may not close in this LLC, but I might close in another entity. That's how you explain it. Once you explain it in that way, then the person questioning you will typically back off and they won't make that assumption that I was referring to. So that's why I have that language. Sidebar to the overall video, but I think it's important you understand that. Okay, back to this. So there's a wholesale deal, standard wholesale. Here's the problem. All right, it's this right here. The way you're making your offers is creating a potential liability that the people who are involved in wholesaling subject to deals are now starting to experience when these deals are collapsing. So the way these deals need to be run is as follows. So if I've got a seller over here, all right, with this deal, and I'm gonna buy this property from her subject to. So this is a subject to deal, all right, not this standard deal that I've been talking about, we just went over. So now in this case, I'm going to have my business entity over here. Okay. And again, don't worry about that for now. We're going to cover that in a moment. So I got my business entity there. Now to put this deal together, I am not going to be using my LLC. Instead, what I'm going to do is I'm going to preface this with a trust. I'm going to make it in the name of a trust. Okay. So the trust is the one that's going to hold it. The contract. So the trust is going to go into this contract with the seller to buy the property. Now, here's what you should be explaining to the seller on this to make sure you ensure that this deal will go all the way through to your end investor. Because if you mess this up, what's going to happen is they're going to get down to closing and the seller is going to walk if they don't understand it, if you drop them on it at the last minute. So you need to explain to the seller that there's a couple of reasons why you're making the offer in the name of the trust. Okay. Number one, okay, the reason why we're doing the offer in the name of the trust is because of the due on sale. All right. Hey, I can't help you out as a seller in this deal if I close in an LLC or I close in my own name, because that's going to trigger the lender and they're going to discover the fact that you've transferred title to this property. And the purpose of setting this up, this deal, and helping you out is to make sure that, I can, how you would describe it to them, walk and fix their situation, whatever they're in, and you're going to take the payments over, blah, 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 blah. But in order for that to happen, I can't alert the lender, because if the lender forecloses on the property or calls a note due, then I'm going to be out all this money and I can't help you. So we have to set it up in a trust, because a trust, okay, falls under the Garn-St. Germain Act. Okay, and the Garn-St. Germain Act permits the borrower to transfer property into a trust, and it will typically not trigger the seller, okay, or not, excuse me, the seller, the lender to accelerate the mortgage. So the name of the trust is not relevant. You come up with any name you want for this trust. Now, what is important here when you structure the trust, okay, you have to have a trustee. And this is ultimately what you have to be aware of, and they have to understand this, the seller. The trustee will be the seller. Okay, the trustee is going to be the seller of this trust. Now, the successor trustee, okay, that is going to be you initially, and then it's going to be your investor. All right, and you'll see why this is in a moment. Okay, now the next portion of this deal that's going to be important here. This is the beneficiary. Okay, so the beneficiary, typically the beneficiary, and this is the way it used to be, the beneficiary was the limited liability company. The LLC would be the beneficiary of that trust. Now, in this scenario, what you're going to do is you're going to make the seller the beneficiary. Okay, now why are you making the seller the beneficiary of this trust? Because if you don't make the seller the beneficiary, you have a new rule that is going into effect on March 1st, 2026. So listen up. Okay, so on 3/1 of 2026, new federal reporting impacts any property transfers. So under the wholesaling, the way we used to do things, right? If you transfer property into an LLC, then that has to be reported to the federal government. So those types of transfers are getting tracked. If I'm wholesaling property and I'm structuring it through a trust where the seller is not the beneficiary of that trust, then that has to be reported. That is, when that property is now deeded to this trust, that gets reported to FinCEN. And when I say reported, here's what gets reported: seller's information and buyer's information. And so personal address, copy of your driver's license. And if you don't do it, huge penalties that come into effect here. Possible jail time, $278,000 per transaction that's not reported. And so I'm going to discuss that in a moment here as someone who's wholesaling property subject to deals, how important that is. And I think you need to put that into your script going forwards with your ultimate buyers. But for those reasons that I just described, due on sale clause in FinCEN, hey, I don't want to trigger anything. The only way you can get around that now, the FinCEN reporting, is to make sure that this trust here makes the seller not only the beneficiary, but they're going to be listed as a grantor in the trust. So in this trust, essentially what you're going to have is you're going to have seller, you're going to as the trustee and beneficiary. Now I know this is, like I said, it can be confusing for your sellers, but hey, I would say you need to figure out a way to work this in to your deals so that you can avoid the risk of the due on sale or the reporting under FinCEN. Now, here's how this changes. So now what you're doing is you're going to have an agreement to buy the beneficial interest that holds title to the property of the trust. So you create the trust, seller transfers title into the trust, then you enter into an agreement with the seller to purchase their beneficial interest in that. And then you've got an investor over here that you agree to sell that beneficial interest, that you're going to sell that beneficial interest to. That's how that wholesale transaction is going to work. So now rather than buying the property, you're buying the beneficial interest in a trust. So what does this do for you? Okay, so here's what happens. I work with my seller. Okay, here's my seller, and they have this property. We set up a land trust now. All right. And I have my LLC over here on the side. And I explained to the seller, hey, we're going to need to move your property into this trust. Seller, you're going to be the trustee, seller, and beneficiary, seller. Now, seller we're going to enter a purchase and sale agreement then, right here, PSA, to buy this trust. So again, just like we have the assignment language, put it in there, you agree to buy this beneficial interest, and you have the ability to assign this agreement to a third party or close and or designated entity. Now, in that purchase and sale agreement that you have for the beneficial interest, you're going to reference the property as well, and they have a copy of the legal description in there. So there's no ambiguity as to what you're actually buying. You're buying a trust that holds title to property. So by transferring this, deeding the property into this trust, so you move from seller's name, let's say Jim, to Jim as trustee of the Green Door Trust. The benefit for you is that doesn't get picked up by a lender. They see that transfer. If they look at it, it's not going to raise any concerns because they're going to assume that Jim, the property owner, set up a trust and transferred their property to it, because these trusts are private documents. Now, Jim's also the beneficiary, right? The seller of the property. So then I find my investor over here that I want to move this deal to. What I'm going to do then is explain to this investor, hey, I have the right to buy this trust that holds title of this property. Boom, you can see this right here. Now, here's the benefit to you. You're going to step in as the beneficiary when you close on this with the seller. So you're going to own the beneficial interest at that point in time. All right, you'll become the beneficiary of this trust. When you take over the beneficial interest, the FinCEN reporting obligation that you had when you transfer property directly to a third party without any bank financing, that is now non-reportable. And here's why. because the transfer of a beneficial interest is exempt. The only transfer that they track is property from this individual into the trust, and that's an exempt transfer. After that, wherever the trust goes, it doesn't matter. So now you keep privacy for this person and this person. That's a win for both of those parties by doing that. Okay, and the bank's not alerted to the fact that this property, the subject to deal, has been transferred to a third party, because what they see on title is Jim as trustee. So here becomes the problem then. All right, now we've got Jim as trustee of a trust, of which, let's say the buyer here, his name is Pete, a trust in which Pete is the beneficiary. So after they close on the deal and Pete steps in as the beneficiary and the seller, Jim, assigns his interest in the trust over to Pete, then Pete will step into the trust, restate it, and make himself the trustee. Because the beneficiary of your trust, he has the power to restate the trust and appoint a new trustee. Now, typically what we do work with our clients in this scenario when we're doing these types of deals is we'll explain to the client, listen, when you're working with the seller, make sure you get a resignation from them that becomes effective at closing. So when the property closes, okay, well actually you do it 5 days after closing, then the seller resigns their position as trustee and appoints Pete as a successor trustee. So that way Pete is appointed by the resigning trustee, and he now, when he redrafts it, is the trustee of this trust. So what we've done is we've minimized the risk, like I talked about, FinCEN and the due on sale clause. So now Pete takes over the trust. So this, I think, is really important on how I would structure these deals. Do not do them directly, because you're going to get reported to FinCEN. And if you do that, then what is going to occur is that if banks start looking and they have access to this database, they're going to know about all these subject to deals. I mean, you already have enough problems as wholesalers with the states cracking down on them now and basically wanting to lock up wholesalers. So why deal with banks and make your life just that much more difficult? Okay, so now what about this LLC over here? What does that need to look like if you're a wholesaler? Okay, so here's the thing. When you set up your business here, typically as a wholesaler, you're going to set up as a limited liability company. Now, in setting this up as an LLC, for most of you, you're going to elect to treat it as an S corporation for federal tax purposes. Because when you're wholesaling, a lot of times we're doing this for cash flow so we can generate income. So when I'm selling assigning this contract to the investor over here, right? Like I just shared with you, here's the purchase and sale agreement, PSA. So this investor, they pay the LLC. So let's say I picked up an assignment fee of $10K on that previous transaction. That gets paid to your LLC. Now, when it comes into your LLC, what you're able to do now with this money, it's active income. It's active income to the business. So the S corporation allows you to take a portion of that and pay it out as salary. So let's assume that this month I paid myself a salary of $3,000. That is active income, and that's subject to employment taxes, right? 15.3% employment taxes I would have to pay on top of income taxes on my salary. Now, what about that other $7,000? Well, that $7,000, if I needed it, I would take it out as a distribution. The distribution is not subject to this. That's why for a lot of wholesalers, they elect to use an S corporation. Now, if you're doing a lot of wholesaling, okay, and you're also buying on your own, using conventional mortgages, and you're working with lenders, then I would not use an S corporation. I would use a C corporation. And here's why. Because with the S corporation, it's flow through, which means you're able to do this strategy right here, pull $7,000 out, and you don't have to pay employment taxes on it. But the problem with that is that it's also traceable, meaning it shows up on your 1040 because you get a K1 from this S corporation. So whenever you go to get your own loan, you're working with a lender, they ask to see a copy of your 1040, they're going to see this business. And then they're going to ask you, what type of business are you in? And then you have to tell them, hey, I'm a wholesaler. Now, a lot of banks have been burned by real estate transactions, and they don't like wholesalers in general because they help people transfer property, right, to another party via subject to and things like that. So, do I really want lenders to know one of those individuals that they don't like? I think not. So, by using a C corporation, lenders don't see that you're in business for yourself on your tax return because the C corporation doesn't flow through to you. So do you pay a little bit more in taxes using a C corporation? Yes, you will, but you have to ask yourself, is it cost benefit analysis? Does it help me accomplish my goals? All right, so wholesalers, typically it's going to be an LLC, S Corp, or possibly C Corp, depending on your business, what you're trying to accomplish with that deal. Okay, now let's go on to talk about some of the important documents. Make sure that you have, if you're doing a wholesale subject to deal, to make sure this doesn't blow up on you on the back end with your buyer. All right, there's two important documents I think every wholesaler who's doing these types of deals need to have. Number one, you need a limited power of attorney so that the buyer, okay, of this property can talk to the insurance or the county or any third party. Because what happens is when people look at title, because you're putting the seller on as the trustee of the trust, they're going to assume that as a third party that they can only speak to the seller. Well, the seller's no longer here. So the buyer needs to be put in that place. So you have to make sure that the seller agrees to issuing out a limited power of attorney to give the buyer the rights to negotiate on behalf and talk on behalf, deal with that property. That's number one. The second thing you need is a third-party authorization to release information. Now, this is a break of glass in case of emergency document. All right, you have the seller sign it at closing, just like you would the limited power of attorney, but you do not send it to a lender. Now, this is what it's used for. It's to send it into a lender so you have access then or able to speak with the lender about the mortgage. So you don't want to send this in right away because if you do, you're going to alert the lender oftentimes that something has gone on. I've seen deals fall apart and banks accelerate notes because people screwed up this aspect of the deal. Everything else went fine. They transferred the property, the buyer stepped into it, and then they made mistakes when it came to the lender, like with the insurance got changed or the business address, or not business address, the address of where statements are being sent were changed, typically out of state. And all this triggered the lender as, hey, something's going on here. They looked and then they saw after their inquiry that the seller was no longer living in the house. It's been transferred to a third party. And then they exercise to move forwards and accelerate the note. So why do you have this? Well, just in case you might need it. All right, so that's why I said it's a break the glass. You hold on to it, file it away. All right, keep it until something comes up. And then finally, I'll put one other thing in place here. What I would do right now is I would put together a disclosure of risks for the seller that the bank could call the note due so they understand this. So I would be listing that out. Here are the risks that you have in entering into this transaction. The bank could call the note due after the fact, so you can't catch them off guard. Also, of course, letting them know that they're selling the property subject to. Many of you already know this. If you're a wholesaler, you know that you need to be letting the seller know. But on the other side, with the buyer, I think you need to put that in place as well. That you should be disclosing certain aspects of this transaction to the buyer, getting them to sign off on it, again, to protect yourself. Because the lawsuits I've been hearing about, a lot of them could have been avoided if they used the right docs to put the deal together so you could go to closing, and they had the right disclosures in place so all the parties knew exactly what they were getting into. Success with these deals really comes down to this in my point of view, right? Having the right documents in place, making sure that you're structuring it the right way, that you as the wholesaler have the right business structure from an asset protection. So if something does go wrong, they sue your company and not you personally. And then you've nailed the tax side as well, made the proper tax election so you're keeping more of what you're earning. I've often told people, build the structure first and you create a business that can withstand the scrutiny of banks, regulators, and better yet, lawyers. Hey guys, I hope you liked this video and you learned something on it and you're able to crush it here in 2026 with your wholesaling business. If you like it, be sure, like I said, smash that like button and look down into the show notes. I've got a link if you want to set up a strategy session. You want to talk to someone here at Anderson on how to set up your wholesaling business, go through some of the strategies that I discussed in this video. It's completely free. Click on the link and sign up for your free strategy session, and we can talk to you about what it is you're doing with your wholesaling business. Take care.